Nothing says the holidays like retail ETFs, like if you're an ETF analyst, I guess. We cover them every single season. This one is a new one. It's an online retail. This is the big new thing, right? So it's a pretty obvious what it does. There's a couple things I need to point out here. First of all, pretty new, 22 million, 58 basis points, a little on the high side. And then the key thing here is the index weighting, market cap. That'll come in handy in 2 seconds. So let's look at the holdings, which is where that market cap weighting is crucial to understand. So you're going to see, obviously, the big popular companies here, because it is market cap weighted, Amazon, Alibaba, right, Shutterstock, eBay, pretty much companies we all love and know. But look at the weightings. 24% in Amazon, 13% in Alibaba. Those two stocks are really driving the car here. In fact, they're responsible for over half of the performance of this thing since it came out. Now, let's look at it versus its competitor, iBuy. And the big difference is, again, the weighting. ONLN is going to market cap weight. So look, Amazon, Alibaba, massive. And then this one's going to equal weight, right? So see these two companies, everything's about a 3% weighting in there. So, and this one has a little more. This is more concentrated. So at the end of the day, Scarlet, look, you're going to basically be betting on Amazon and Alibaba. If you are bullish on those companies, then the other one will be the right choice. The weighting is key here.
It all comes down to looking underneath the hood. Now, still with me is ProShares Global Investment Strategist Simeon Hyman. Simeon, retail stocks, retail ETFs get a lot of attention this time of the year, but they don't necessarily outperform at this time as well, because we all know a sales bump is coming. It's pretty much priced in. So when do you position for a run-up in retail companies?
Well, you know, this year we have a very short season, so we all know Thanksgiving's very late. You'll note, I've seen you guys talk about it, XRT, the big shorted retail ETF. There's been a run-up in some of the legacy brick-and-mortar players who've had some decent times this year, but we're up against some good expectations. The good part is, for those who want to be bulls, last year was tougher. Remember, we had an equity market sell-off. The Fed was on the wrong foot. Lots of headwinds that aren't really there this year. The consumer's in a pretty good place.
And then let's talk about clicks. So ONLN is long only, plain vanilla. Then clicks basically goes short the brick and mortar. So talk about the influence of XRT. XRT is highly famous for being shorted, like 300% of its shares are shorted. And the trade had been long Amazon, short XRT. That was the death of them all trade. Is clicks, was it inspired by that? Is that sort of what you're trying to make easy?
Yeah, that's definitely the package theory here. And, you know, the key here is that XRT is all bundled together. In other words, the online and the brick and mortar folks are all in that index together. So if you look at performance year to date, so we have our online store index, which is what ONLN follows, and then we have our brick and mortar index, which is the short leg of CLIX, which is 100 cents long, the online folks, and 50 cents short, the brick and mortar folks. If you look year to date, the online index is up mid-teens, 13, 14, 15%. The brick and mortar side is roughly flat. XRT is sitting in the middle. So if you want to split them up, because it's very clear that the prospects are very different for the two, we think we've given a very surgical solution for that.
So ONLN and clicks are both thematic ETFs. They make sense to people. It mirrors what's happening in the world around us. How big a factor, how important is the narrative or the story you tell when it comes to pitching and selling the idea of a thematic ETF?
Most thematic ETFs have an idea that resonates viscerally with folks. So what you've got to do is you've got to explain to them what was the logic that made that into an investable idea. And Eric hit on a very important point. We thought that on the online side, market cap weighting was important. Scale is everything. But on the short side, on the brick and mortar side, we actually equally weighted it. So you might have been surprised. Some of the viewers might be surprised to hear that the brick and mortar index is roughly flat this year, because all you hear is that Best Buy, Target, and Walmart have all done well. But if you look on average on an equally weighted basis, the roadkill's all over the place. Kohl's, Children's Place, Macy's, you just keep going down the list.
And speaking of your theme ETFs, pause, got to cover this. It hasn't done a great job. It's trailing the market by like 15% since it came out, but it's got 50 million.
And it's got a great story.
Yeah, is that the story selling? Just talk about when you talk to advisors about the pet care industry.
So it's back to the story is almost irrefutable. I mean, we know there's more pets than children, and everybody's spending all this money, premiumization, and it's $20,000 for a new knee for your dog or a hip. All these things people know. How do you make it investable? And, you know, our focus was making sure there were enough pure plays out there, which there are. You know, the Chewy's, the Elanco's, and having a small representation of the conglomerates like the Smuckers of the world. So we did it right. We put the construction together. If you look at performance, one thing that I think is really important, a little over 50% of this ETF is pet health care. You know what there isn't? There is no Medicare or Medicaid for dogs. And if you look at the performance against the healthcare index, you'll see when that healthcare index takes a hit because everyone's talking about Medicaid for all, you'll see outperformance from the pet care ETF.